Think about the last time you opened your retirement account and clicked, Change Investments. You're staring at a list of funds. One of them looks exciting. Big 1-year return, strong 3-year number, maybe a shiny star rating, maybe a top performer badge. Right next to it is the boring index fund. Flat name, plain description, no hype, and you can feel the pressure. Because the screen is basically daring you to pick the winner. You hover over the managed fund because it looks like the smart move. Like you're being proactive, like you're not leaving money on the table, but you hesitate. Because what if you're buying something right before it cools off? What if the safe choice is secretly the smarter one? Here's what most people don't realize. That little comparison screen isn't neutral. It's not just showing you options, it's steering you toward a very specific kind of decision, one that feels rational in the moment, and quietly punishes you later. That moment you just recognized, this fund is hot, maybe I should switch, moment, has a predictable outcome. You end up buying after prices already rose. And when the fund has a rough stretch, you feel dumb, you panic, and you sell after prices fell. That's not a personality flaw. It's design. Managed funds and fund menus are built around recent performance. Recent charts, rankings, star ratings, quarterly updates. The system shines a spotlight on what just went up, because that's what grabs attention, and attention creates movement. Movement creates money. Let me be clear about something. The biggest damage isn't always the fund itself. It's your timing inside the fund. Morningstar tracks something called the investor return gap. That's the difference between what a fund reports it returned, and what investors actually earned because of when they bought and sold. In their Mind the Gap research, Morningstar found that over the 10 years ending December 31, 2024, investors earned about 7.0% a year while the funds themselves returned about 8.2%, a gap of roughly 1.2 percentage points per year. Now here's the twist. That gap is the entire story. And it's what the 843 rule is trying to make obvious. A fund shows you an 8 to get your attention, it cools to a 4 after the hot streak fades, and your lived return ends up closer to a 3 because you got pulled in and pushed out at the worst times. And yes, it goes deeper than that. So first, you need to understand what the 843 rule is actually measuring. It's not a math law. It's a behavior loop. The 8 is the flashy, recent return that gets marketed and selected. The 4 is what often follows, returns drifting back toward normal once the hot streak ends. And the 3 is the part no one puts on the brochure, your personal result after you chase, switch, and miss the rebounds. There's real evidence that recent winners don't stay winners for long. S&P Dow Jones Indices publishes a persistence scorecard that tracks how often top funds stay on top. The pattern is brutal. Only about 5% of top quartile funds stay top quartile over the next 3 years, and about 2% stay top quartile over 5 years. Now picture a busy professional, call them Marcus. 2 check-ins a year. One in January, one around open enrollment. A managed fund pops to the top because it crushed last year. It gets the stars. It gets the top label. So Marcus shifts more money into it. Then the streak breaks. The fund drops, the platform reshuffles the list, and now a different fund is winning. Marcus doesn't think, mean reversion, that's just returns cooling after a hot stretch. Marcus thinks, I picked wrong. So he switches again. That's the 843 cycle. Not because you're reckless, because you're responding to what's highlighted, and once you see that, you start noticing something even more uncomfortable. The menu isn't just showing performance. It's manufacturing your next, perfectly reasonable, buy high, sell low decision. The cycle gets even stronger when you look at the nudges baked into the choices you're given. Platforms love short windows. 1 year, 3 year, maybe 5 year. They default sort by what just did best. They add star ratings that are tied to past performance. They publish top performers lists. And quarterly commentary gives you a story for whatever just happened, which makes switching feel justified. Here's what most people don't realize: order is persuasion. If the best recent return fund is at the top, your brain treats it like the recommended option. This isn't hypothetical. Research on choice architecture, how options are presented, shows that simply moving items to the top of a list changes what people pick. In a field experiment described in a retirement savings context, sorting and highlighting top-rated options increased selection of those top-ranked funds by roughly 5 to 7 percentage points. Now play that out in your life. Your annual bonus hits. You log in. The managed fund is the first thing you see because it had an amazing year. You add more. Then the market turns. That same fund looks risky because the recent chart is ugly. The boring index fund suddenly looks safe because it didn't swing as wildly. So you sell the managed fund after it dropped, and the real punchline? When you sell after a drop, you lock in fewer shares. So when the rebound comes, and rebounds are how long-term returns happen, you're not fully there for it. Even if the fund's long-term average is fine, your timing turns normal volatility into permanent damage. And once you see how the menu manufactures the decision, you're ready for the part that stings. The system doesn't just cost you with timing. It often charges you for it, too. You've just seen the loop and the nudges that trigger it. Now you need to see the bill. Because the cost hits you twice, and that second hit is the one most people never calculate, because here's the part that's easy to miss. You're not just losing to bad timing. You're often paying extra while it happens. Leak number 1 is visible. Fees. A managed fund takes a slice every year through its expense ratio and sometimes other costs. That slice comes out whether the fund had a great year or a brutal one. Compounding doesn't just grow returns, it also grows the damage from small annual drags. Leak number 2 is sneakier. It's the behavior gap. Morningstar's Mind the Gap research found that, over the 10 years ended December 31, 2024, the average dollar invested in U.S. funds and ETFs earned about 7.0% per year while the fund's aggregate total return was about 8.2%, roughly a 1.2 percentage point annual gap from timing and trading. Now make it human. You're a smart, busy person. You're not day trading. You're just reacting to what the screen makes feel reasonable. You add more after a hot run because it looks proven. You cut exposure after a bad stretch because it looks dangerous. That single habit hits twice. First, you miss chunks of the rebound, so the market's volatility becomes your permanent loss. Second, if you did it inside higher cost funds, you also carried a bigger fee drag while you waited for proof. Again. This is why the boring index fund quietly wins. Not because it's magical, because it gives you fewer reasons to tinker. Less story, less ranking chasing, less, maybe I should switch. So what do you actually do with all of this, so you stop paying the double cost and keep compounding on your side? Here's exactly what to do. Simple rules that block the 843 trap before it starts. Point 1, ban 1 to 3 year performance from your decision. Literally, if the reason to buy is, it's been hot, it's disqualified. Your core allocation doesn't change because of recent returns. Point 2, build a boring core first. In most plans, that's a low-cost broad index fund, or a simple 2 to 3 fund mix. That's your default, not your backup. 3, if you still want a managed fund, cap it. Make it a small satellite slice you can hold for 5 to 10 years without switching. If you can't promise the holding period, you don't get the position. Point 4, automate contributions per paycheck. Not when you feel good. Not after your bonus. Automation forces you to buy in good markets and bad markets. Point 5, rebalance on a calendar. Once a year is enough. Targets only. No vibes. This quietly forces buy low, sell high behavior. Point 6, use a switching checklist before selling. Did your goal change, your time horizon change, or the fund's strategy change? If the answer is no, underperformance isn't a reason. It's just a season. If you want the next step, watch the video on building a clean 2 to 3 fund portfolio inside a 401k without overthinking it. And if this smart friend breakdown helps, subscribe, so you keep getting the stuff the menus don't explain.